The market efficiency debate is alive and kicking. The concept of efficient markets is that all prices reflect all of the available information. This means that it is extremely difficult to identify arbitrage opportunities in the market, as assets are always correctly priced. This fair pricing is obtained through the aggregate behavior of a large number of rational investors operating in markets, leading to swift information processing. The assumptions that the efficient market concept adopts are, firstly, investors will act rationally to maximize profits and do not make errors. Secondly, all information is available to all investors so that there is no information asymmetry. Thirdly, there are no transaction costs, namely taxes or brokerage fees, to ensure capital use is not restrained. The implications of the efficient market theory on returns is that prices will follow a random walk and move unpredictably and are not related to past prices, making it tough to forecast price movements and generate a return regularly. The theory is also aligned with the capital asset pricing model and implies that return will increase only when risk is increased also. Additionally, the validity of active portfolio management is questioned if it is so difficult to beat the market, and instead a substitute such as a passive index fund is best suited for investors looking to maximize returns. Many economists argue about the validity of the efficient market hypothesis. An argument to support it is the random walk theory, which suggests prices change unpredictably and are not based on past prices. This is in accordance with prices taking into consideration all information available. Additionally, market microstructure analysis by economists has investigated the speed at which new information is adopted by prices and shows it is difficult to construct a trading strategy based on historical data that beats the market over time. Another argument in support of the efficient market hypothesis is the Farmer-French three-factor model. Its factors, market risk, size risk, and value risk, explain a large proportion of stock returns. This purports that returns are derived from systematic risk, not from market timing. Some evidence against the market hypothesis is the existence of bubbles. Bubbles occur when the price of a security significantly exceeds its value due to speculation. If the assumptions of the efficient market hypothesis were correct, then bubbles like the Cuba bubble, mentioned in the Chicago Booth Review, big question, are markets efficient? As well as the housing bubble of 2008 and the late 1990s dot-com bubble. More evidence against the efficient market hypothesis is investors that act irrationally. Behavioral economists study how and show that irrational behaviors such as overconfidence, loss aversion, and herding lead to pricing mistakes and distort efficiency. My personal opinion on the topic of market efficiency lays in support of farming. I believe that markets are efficient, however, I do not believe that prices accurately reflect the value of a security all the time. Humans make errors, which leads to significant pricing distortions. I believe in farmers' work that demonstrates that higher risk is derived from higher returns, and that prices are not predictable and are not related to past prices. One testable implication that returns are not predictable is the absence of serial correlation in stock returns. In case study 1, the company NVIDIA has a Doug and Watson value of 2.032, which is very close to 2. This indicates that there is no serial correlation between the data points, and the previous data points show little indication that they are predictive of future data. This supports the efficient market hypothesis, as it indicates that the prices follow a random walk and are unpredictable.